Well, this week, mortgage rates took a strong, wild ride. We started off strong, rates hit their lowest level since December 9th, but by midweek, the market flipped and rates bounced right back up. So what happened? Let's break it all down. At the start of the week, the average 30-year fixed mortgage rate was sitting around 6.74% for top-tier borrowers. That's a big drop from where we were just a few weeks ago when rates were still over 7%. But by Friday afternoon, after a roller coaster of economic data and market reactions, many lenders had adjusted their rates back towards the upper 6 range, with some even creeping closer to 6.9%. So while we're still in a better position than earlier this year, this week was a reminder that mortgage rates can shift fast, and those waiting for the perfect moment might end up paying more. To understand why mortgage rates move, you have to understand that rates are directly tied to the bond market, specifically the 10-year Treasury yield. When investors feel uncertain about the economy, they tend to buy bonds, which pushes yields lower and mortgage rates down. But when economic reports come in stronger than expected, investors pull their money out of bonds and put it back into stocks, which pushes yields up and causes mortgage interest rates to rise. This week, 3 big reports hit the market and shook things up. The first was the ISM Manufacturing Index, which happened on Monday. This report tells us how strong the manufacturing sector is in the U.S. This headline number looked normal on the surface, but when you dug deeper, the details were ugly. New orders and employment fell hard, which is usually bad news for the economy. When investors saw this, they bought bonds and mortgage rates improved. The jobless claims on Thursday tells us how many people are filing for unemployment benefits. The lower the number, the stronger the job market. And this week, fewer people than expected applied for unemployment, which means that the labor market is still tight. Investors saw this and thought, well, if jobs are strong, inflation could stay high, and the Fed may not cut rates soon. That made them sell their bonds, which pushed up mortgage interest rates. And then, of course, today on Friday, the jobs report came out, the biggest report of the week. Early Friday morning, rates were looking good. Weaker job numbers means lower rates. But then as the day went on, the stock surged, bonds weakened, and rates climbed back up. But why? Well, the report was open to interpretation. On one hand, job growth slowed, which was good for rates. But on the other hand, wages kept rising, and that could keep inflation higher. But by the afternoon, lenders adjusted rates back up to where they were earlier in this week.